they look at every senior in America and they say, man, there's this big bucket of retired minimum distribution money coming out of these accounts. I can't wait. And they're like licking their chops.
Do you want a wealthy retirement without worrying about money? Welcome to the Retire in Texas podcast, where you will discover how to enjoy your faith, your family, and your freedom in the state of Texas. And now, here's your host, financial advisor, author, and all-around good Texan, Darryl Lyons.
Hey, this is Darryl Lyons, CEO and co-founder of PAX Financial Group, and you're listening to Retire in Texas. This information is general in nature only. It's not intended to provide specific investment, tax, or legal advice. Visit paxfinancialgroup.com for more information. Also visit Pax Financial Group. You can hit the Connect With Us button. You'll connect with a financial advisor for 15 minutes. They have hearts of a teacher, and that 15-minute consult can be over the phone just to see if it's a good fit. I don't know if generally we can help you. We may not be a good fit, and you don't know as well if you even like us. So that 15-minute consult is just a really easy, no obligation way to connect and just see if it's a good fit. So want to encourage you to do that. I want to talk, I've gotten multiple requests for this one, required minimum distributions. And hang with me because this one might be a little nerdy. I don't know if you've noticed, but I generally stay away from numbers on the podcast. And one of my favorite compliments is, hey, you dumb it down for me, Darryl. Thank you so much. It's not my intent to show disrespect by communicating in a way that's, layman's terms. In fact, oftentimes I get, I listen to my peers and their production of different content, and they're so sophisticated and intellectual. And I feel like I fall short on that many times in this podcast, but I do that intentionally because I think there's just a lot of us out there that need to hear the basics in kind of digestible pieces, and it's not overwhelming. And so that's why there's not a lot of math, and it's 15 to 20 minutes, and that's why my books are short. And so I just really try to meet you where you're at. My videos are 30 seconds. But this one, I'm going to go a little bit deeper. I say all that because I'm going to go a little bit deeper. I'm going to have to use some numbers for this one. And this one's just a byproduct of multiple requests. So hang with me on this one. I'll try not to make it too dry, but it's an important one. It's really based on required minimum distributions. And so a lot of us have IRAs, and I bet you don't know what IRA stands for. It stands for Individual Retirement Arrangement. You probably thought account. It's actually arrangement for whatever reason. So the Individual Retirement Arrangement, IRA, is just a powerful tool. I've run modeling before and said, okay, if somebody invests on their own versus using an IRA, which one grows more? And, as you would imagine, the IRA grows more. And you say, why? Well, because the earnings on that IRA are not subject to taxes. So there's not somebody coming along with the shovel and taking money out of the ditch, so to speak. So that really helps, right? Every year your growth is not being subject to taxes. Now, interesting point, you typically don't pay those taxes from the account. You usually pay it from your personal income, but altogether it still hurts. So if you were to model it out and run spreadsheets, you'll find that IRAs outgrow, assuming the same types of investments, outgrow non-IRAs. They just do because they don't have somebody coming along taking away, and that somebody being the IRS of their earnings each year. And if you're really thoughtful about it when you're doing your planning, and a good advisor can help you with this, if you've got multiple types of investments, maybe you've got some investments in non-IRAs and you've got IRAs, you put your investments that have taxes, a little bit more taxes each year, in your IRAs. And how do you find those investments? Which investments have more taxes? And those are funds that have more turnover, or strategies that have more turnover. And whenever things are turned over, like stocks are being traded, those create taxes. And if you put it in an IRA, you can trade all you want, and it really doesn't matter because it's tax deferred. So I love mathematics. I just love it by the sheer math. IRAs grow better, all investments equal, than non-IRAs. Then you've got the The Roth IRA, which was invented like in 1994 by the senator from Delaware, Senator Roth, that allows you to put money into an account and the money comes out completely tax-free. And that's really where we're going with this conversation, because there's no required minimum distribution, generally speaking, on Roths. And by the way, all this conversation, there's always exceptions. So I'm going to kind of keep it high level, but get with your advisor. I'll put a link to the IRS publications in the show notes, but there's exceptions to all these things. So just keep that in mind. But the Roth IRA generally doesn't have any required minimum distribution, which is awesome. And your money comes out completely tax-free. Awesome. Like if you see your account balance is 100,000 and it's in a Roth, that's all your 100,000. If you see your 100,000 in a traditional IRA or your 401k and it's pre-tax money, that 100,000 that's on your statement is only about 80,000 of that is yours. So love Roth IRAs. The challenge is most people have money in traditional IRAs and 401ks because Roths haven't been around as long. So traditional IRAs have this thing that you just got to be aware of, and it's called a required minimum distribution. This is the minimum amount of money that you got to take out at a certain point in your life because the IRS needs to get paid. It's like this, like when they sit around and up in DC around a room and they say, how do we get money to pay for all these bills? They look at every senior in America and they say, man, there's this big bucket of retired minimum distribution money coming out of these accounts. I can't wait. And they're like licking their chops because it's a huge amount of money that if you own a traditional IRA and you're 73, that's the new number, except if you reach 72 before 2022. I don't know if that makes sense. But let me say it this way. If you reach 72 after 2022, then your required minimum distribution age is 73. They've changed that a lot over the years, last several years. It used to be 70 and a half. Now, just know it's about 73. Some exceptions in there. Check with your advisor. So if you're 73, you've got to take out money. And the IRS is licking their chops because they're going to get paid. And so you take out money. And the way it works is that, and advisors help you with this. Although I will say this, the IRS says it's the responsibility of you as the owner of the account to do this right. And so now we feel very responsible for helping you do it, but it really comes down to you as the owner of the account doing this right. Again, most institutions really help you make this work, but you've got to take it out. You got to take it out at age 73. Not all of it, but some of it. I'll tell you how that calculates in just a second. But very important, because if you don't take it out, there actually used to be a pretty hefty penalty, and they've watered that down a little bit. But if you didn't take it out, they used to charge you 50% penalty, which was absolutely insane. And they've changed that under the Secure Act 2.0. Now it's 25% penalty, which is still stupid. But if you correct it, it might only be 10%. So still painful, and you don't want to deal with it. So you've got to make sure that you take your required minimum distribution out at the right time, typically 73. Now, so let's say you turn 73. In the year you turn 73, you don't have to take one out. You can take it out the following year. But then now you've got two coming out in the same year, so that could bump your taxable income up. So you got to be careful, work with your advisor. But basically at 73, you've got to take money out. Again, not all of it. It's a calculation. So the calculations on the IRS website, again, I'll put a link in here, but let me give you an example. Let's say, again, it's like married filing joint. They have different calculations, but it's basically life expectancy tables. So they basically want you to withdraw the whole thing by the time you die. And so if you're married filing joint, that's one calculation. If you're single, that's another calculation. If you're married filing joint with a spouse that's 10 years younger than you, that's actually a different calculation. So here's an example. Let's say this is actually 72, so it's a little older, but it still works. Let's say you had 100,000 and you looked at the tables. The life expectancy of a 72-year-old is 27 years, 27.4 years. So you take 100,000 divided by 27, and you've got to take out $3,649. So that would be the amount of money you've got to take out. And so you also want to know that they look at the balance at the very end, December 31st of the previous year. So if the market crashes like right at the end of the year, that's actually good for you because then you have to take out less money the following year. So just don't know that. But check this out. So at age 90, every year this required minimum distribution gets more and more. So in that example, somebody 72 takes out $3,649, but somebody who's age 90, that formula is different. They have to take out $8,000. So the RMDs go up as you get older. If you have multiple accounts, you can take your RMD from one account. You don't have to take it from every single account. The challenge with that is, to me, it just kind of brings in some red flags that, hey, somebody's going to probably bug you. You never took your RMD from this account. And then you've got to do some explaining, which is fine, but just keep good records. So nobody comes along and says, oh, this account never took RMDs. And you're like, I calculated it based on all of the accounts. So in other words, you can take the RMD from one account. You don't have to take it from individual as long as it's the total that you're supposed to take out. Now, you can kind of work around this required minimum distribution a little bit. Roth IRAs, which I love, don't have this required minimum distribution. While you're working, you probably know about this, but you can roll over your 401k or IRA. That's tax-free. You don't have to worry about that. If you made, along the years, some people make non-deductible contributions to the IRA. Now, typically when you make a contribution to a 401k or traditional IRA, typically that money that you put in there reduces your taxable income. It's a deduction of sorts. But some people, because their income's too high, they don't get to deduct their traditional IRA, so they have a non-deductible. If that's you, you know what I'm talking about. If you have non-deductible contributions to your IRA, those hang with me. Those non-deductible portions are not subject to RMDs. So, but make sure you keep good records of that. A really cool thing to know is a qualified charitable distribution. So this is one of my favorite things to do is instead of taking your RMD, you just send that money to a charity. And I love this. You can do this up to $100,000 per person, $200,000 married filing joint. And so you say, I don't want my RMD. In that example before, I said like $3,000. I don't want it. Just send it to a charity. That's perfect because most people aren't getting a charitable deduction, especially if you're a senior. Because the standard deduction went up so much, the charitable deductions are not really applied for many, many people. So if you're not doing a charitable distribution, here's what's happening to you. You're taking money out from your retirement account, your IRA. You're paying taxes on it, let's say $600, and then you're donating it and you're not getting a deduction. So basically, by sending it directly to the charity, in some cases, you're avoiding a $600 IRS payment. And we're called to, we need to pay the IRS, but nobody's required to leave a tip. So if we can do a charitable contribution, qualified charitable distribution, I think, need to look at that and work with your advisor on that. The one thing to know too, I think is often lost on us, is, what happens to my account when I die. And generally speaking, your beneficiary has to take the money out. This is a different RMD rule over 10 years. That rule was more confusing in prior years, but it's generally your beneficiary. Let me say this clearly, your non-spouse beneficiary. If it's your spouse can take your IRA and roll it into theirs. So that's generally the rules. But if it's a non-spouse, if it's a child, then they have to take the money out over 10 years. And so keep that in mind because some kids could be in a high tax bracket and you might want to think about should I pay for some of that now? So that's something to consider. I think the really good planning that is done in a lot of this is thinking about not only how to minimize here's how I think about it. I want to minimize my lifetime tax payments. And so a lot of us over the last several years have really been thinking about not only while we're living, but our beneficiaries and converting our traditional IRAs to the Roths. So that way we're not subject to the same RMDs. And then those monies that come out down the road are completely tax-free, which is really cool. So I really want you to encourage working with your advisor to try to reduce your RMDs down the road. And I think it's really important too, because we know the federal government's going to have to find this money somewhere. And like I said, they're licking their chops. And so if you can reduce your future RMDs, I really think that's going to put you in a good position down the road for both you and your beneficiaries. Oftentimes we don't think about the beneficiaries, but I think it makes sense. Again, we don't want to leave the IRS a tip. If you leave a trust as your beneficiary, that's a different rule. That's a 5-year rule, so a little bit more aggressive RMDs there. Again, you can't, I mentioned this maybe in the previous podcast, you can't borrow against your IRA. You can borrow against other investments, but not your IRAs. And then I also want to make sure that if you nerd out on this a little bit, if you look at your IRS forms, make sure the forms have the right letters on them. Like, for example, and you can check with your advisors, but sometimes we just don't even look at our tax returns, but the codes on them make sense. So like a code B would mean a Roth distribution not subject to tax, but a code J would mean an early distribution from a Roth, which could be subject to a tax, so maybe even a penalty. So those codes on your IRS forms, I always just encourage you just to look at those, just make sure they're right and check with your advisor. Again, if there's a problem, it used to be a 50% tax. Now, if you get it corrected timely, it could be 10%. I don't know that, I've never experienced this. I think it can even be 0 if you could substantiate that it was an administrative error, but I don't want to mislead you there. But RMDs are definitely something that you want to plan out and think about and do the calculations. Again, I'll put a link. There's calculators in there. Your advisor can help you with that. We got all kinds of tools. I really think it's funny because when you go through the IRS website and look at this stuff, they put in random things that they're trying to support. Like they put in this little paragraph kind of in the midst of all of the nerdy stuff. They put in here photographs of missing children. The IRS is a proud partner with the National Center for Missing and Exploited Children. Photographs of missing children selected by the center may appear in this publication or pages that would otherwise be blank. You can help bring these children home by looking at the photographs and calling. I think that's nice. I think it was just kind of odd to see kind of these in these IRS publications, just kind of this random request. So try my best to blow through that in such a way that it's not overwhelming. It gave it a little extra energy this morning, and I hope it makes sense to you. My final take would be do some thinking through your RMDs as you plan out what that looks like, and here's your goal, try to reduce your lifetime taxable income. We're all required to render under Caesar's what is Caesar's, but none of us are required to leave a tip. Remember, you think different when you think long-term. Have a great day.